Hello guys, welcome back to Castawaytrader YouTube channel. So here I am traveling in Europe. We left our beautiful island for several months and we will be back in late September. Now we are in beautiful city of St. Petersburg, Russia, and here on the screen you see a new skyscraper they built here. This is the tallest building now in Europe, and this is the headquarters of Gazprom, the main corporation which explores natural gas and exports it to Western Europe. Just to remind you, I have website www.castawaytrader.com, and you can also follow me on Twitter @Castawaytrader. Before we start, please read the important information. Okay, so I would like to start with reminding you the basic fractal structure and the harmonic Elliott waves. This is 5 waves up, and the main idea why we track it until it gets completed, you should still stay bullish. Once it gets completed, so you can start trying to counter trend that move, because the completion is here, and basically we can expect a major correction which may be shaped as ABC, A, B, and C. And so the story of this video is about tracking those 5 waves and specifically the very last ABC move up. And I would like to start from showing you the fractal from 2000, and this is SPY cash index. And my friend Matt paid my attention to that. He trades only based on fractals. He looks back in history, back in time, and just looking very similar pattern, and then he tries to find similarity between what happened then and what's happening now. And this is exactly the core idea behind Elliott waves. So you should understand that word waves should not discourage you. This is just the way how you find similarity in fractals back and then. And the beauty of invention of the waves by R.N. Elliott was that he just came up with the way how we can find those similarities, and he found major patterns which would repeat again and again. So as he showed you here, once we have the major advance in wave 3, we normally have a pullback, ABC down in wave 4, and from here we should get ABC up, which would complete the whole structure. And it's very important that the last leg up here, wave C of 5, should make another high over the high made in wave 3. That would be another high, all-time high, or just another high, but it should be higher than this one, and that would complete the structure. And here we see a beautiful example of the structure. I don't show you the huge rally in wave 3 because we are concerned here with the completion stage of that move. So we have nice ABC down in wave 4, and we have wave A, which in this case made a high over the high of the wave 3. It's not necessary. It could stop here. This is not the rule. What is really important is that wave B down here, the red one, should never go under the low of wave 4. And another rule, that second leg up, that subwave C of 5, should always make a high over the high made in subwave 8 and over the top made in the previous rally of wave 3. Now let's compare it. So basically now you will see a nice example how Elliott waves work. Basically we use the very same notations, you see 3 3, 4 4, 5 5, which help you to pinpoint those major pivots, which help you to identify structures, find similarities in them. And here you can see that those two patterns are very similar. So that pattern comes from 99 2000, spring 2000, and that pattern is what's happening now to Nasdaq index. As you can see, you can actually find similar patterns in very different instruments. Here I could bring you a very similar pattern in crude oil, in natural gas, in gold, because all those patterns are produced by human psychology. We still work as a crowd, we still make decisions as a crowd animals, and that's why, 18 years after that pattern, we keep producing the same pattern in different instruments. This is amazing, and this is why I love Elliott wave work. Okay, so here we see pretty nice topping pattern. I'm talking now about Nasdaq. We had A up over the top of wave 3, very nice sharp pullback in wave B. I keep telling you that those wave Bs are hardly predictable with ugly structures. I mean, it's very difficult to get any reliable structure here. What you could play here is just inverted head and shoulders. It's left shoulder, head, and right shoulder. This is my favorite pattern, by the way. And here we could have very nice 5 waves up in a subdivision of that wave C of 5. Indeed, A, B, C, this is wave 1, 2, A of 3, B of 3, C of 3, 4, and this is wave 5 of C of 5. And basically, if you followed me, you were warned in advance, so we started to track that pattern 10 days ago actually, and we had plenty of time to build our short position. Okay, so let's look at S&P in 2000 on a wider perspective, just to see what happened after that. So we can see that once the 5th wave was made, we had a very sharp decline in subwave A, and this is a very textbook pattern, guys. This is why I'm showing it to you, so you would get a perspective of what could happen next. And then we get again another ugly B, and then even more powerful decline in wave C, because majority of corrections in the bull market happens in ABC form. And you can see that basically if we compare that pattern to Nasdaq, so now S&P has a little bit different pattern. So this is why I show you back to back a pattern from 2000 for S&P, but here I don't show you S&P for 2018, but instead I show you Nasdaq, because I do not have a similar pattern here for S&P, but I have a very similar pattern in S&P of 2018 to what happened here. So basically S&P is a little bit far in that count than Nasdaq. So it seems like what we did from February 2018 until July 2018 was a corrective wave B up, because we got the very same, look, it's 2018, the very same weak wave A. This is it. So first we got a plunge ABC in subwave parenthesis A, and that might be it. And then after that weak A, we got a move back in this ugly structure, and this is our red B. Look, it's 2000 year, it's 2018. And then we got an advance which can be counted as 5 up. Look at that. It's not a really nice structure, for the reason is that subwave 3 has not reached 176.4 extension, and this is a sign of weakness. That actually may be a good sign that that rally is corrective. And finally, we completed 5 waves up in subwave C, but look at that. That C was unable to take out the high made in wave 3, and that could not be counted as the very same pattern we actually found in Nasdaq of 2018, and that pattern we found in S&P in October 99, March 2000. So it's something completely different. And managed to find that pattern a little bit far from April 2000. So it happened between April and September 2000. And as I mentioned before, it really looks like a corrective wave B. So if we have just stopped in that corrective wave B up, so we have just started our decline. So we may be still here, and we still have a lot of opportunities to short that wave, because basically the rule of thumb is that wave C down would be at least 100% of size of that first decline in wave parenthesis A, but in majority of cases it would be 123.6%, so it would be longer than A, or in some cases 176.4% or even 200% of the first leg down of that parenthesis A. So it looks really toppy in both indices, S&P and Nasdaq. And let's come back now and see how we were tracking that pattern and how we were getting prepared to trade it. So let's start from July 17th, and here I will only be referring to the public post I made on my Twitter account at Castawaytrader. So on July 17th, I warned my followers that we still grinding up to complete that structure. So here I did not have that clear vision I have now. I counted a little bit differently, but even when I counted it as A up, B down, and I was expecting here a completion of wave C up. 2 days later, on July 19th, I warned my followers again that ES can stretch a bit higher into the target red box. So why I had that red box here? So I had a bunch of different extensions here. I was looking at that leg up, and I saw that corrective leg down found its bottom a little bit over the bottom of that B. So that's why the alternative would be, it would be some kind of wave C, and I expected that wave C would stretch at least to 100% of that first leg up, or what would be better, 123.6% of that previous leg up. But what was even more important in that landscape was those unfilled gaps left back in February 2000 when we started that powerful decline. I normally highlight those unfilled gaps in blue color, so we easily can be seen on the chart, and here we have 2 of them. And again and again I see that those gaps become not only the target but the major reversal areas, because so many forks got trapped here. So they kept buying here, and once it suddenly reversed, they just did not want to sell, and the more we waited, the lower price got, and we just decided to hold it. But by the time we came back up here, 6 months passed, and those guys, they are dreaming about getting out of position. They just want their money back. They don't care anymore. They don't care about potential breakout. They just say, give us our money back. And that's why once we fill those gaps, all those guys who passionately been waiting for that for 6 months, we would immediately sell. We would not be waiting for profit. We want the money, we would sell it. And that's why once we enter that area, we have a huge crowd of trapped bulls from the past, and this is additional source of supply for the stock. So that's why I was pretty sure that we would, if we get to that blue zone, and basically you see once it stops at once, it's amazing, look at that. Sometimes, you know, those bulls are so desperate to get out of their positions, we would not even wait until the price fills the gap, we would just sell it right here with small loss, just for the sake of getting money back. And sometimes when the market is strong, those gaps get filled. So that's why I thought, okay, in the worst case scenario, so we would get up here to 285, because this is where we had that upper unfilled gap down. So at that point, when we tagged the lower band of my red box, which has not changed for days, I started a small short position. I bought 15 puts, and again you actually can see that I started a small position because I did not see a well pronounced wave 4 here. That could have been a wave 4, that could have been just the whole wave 3 here. So the microstructure here mattered, and I saw that we still had chance to keep grinding up, and I did not want to load a lot of puts just to be able to add more in case it would keep grinding higher. The rule of thumb: in the bull market, do not go short buying puts on Friday close, and the reason is that there is risk that the market would not collapse over the weekend. We would open at the very same price level, but because of time decay, you would immediately lose 20% of the value of your puts at the open on Monday, even if price does not change over the weekend. Even if price was grinding higher the whole Friday afternoon, and it closed at the top of Friday, and it really looks overbought, and if we are in a bull market, if we are over the major moving averages like 200-day moving average, 20-day moving average, you should understand that yes, we can get a pullback, but that pullback may happen overnight during the overnight session on Sunday. And what I saw many times, but if it happens on Sunday night, it may come back up to the very same top we closed on Friday by Monday open. And if you hold puts on ETFs, they are traded from 9:30 a.m. Eastern time until 4:10 or 4:15 p.m. Eastern time, meaning that you would not be able to close your put position during that overnight Sunday session. If you trade SPX puts, so then yes, you would be able to close your position on Sunday night, but I'm not sure whether I would be able and I would enjoy watching the screen the whole Sunday night instead of hanging out on the beach with my family. So it's not for me. So if you trade options on ETFs like SPY, QQQ, IWM, you won't be able to book your sudden gain during overnight session. That's why my rule of thumb: never open short position in puts on Friday afternoon. So that's why I decided to close it for a small gain of around 30% just before the close. And nothing happened over the weekend, and on Monday I made another post, so no change in the count and the setup. It has tagged the minimum target of 100 extension. If it stretches to the next target of 283.30, it can justify a short for upcoming subwave B down. I meant that B down or that scenario. And here again, look at that. We had that nice gap, and that gap is still the potential first target for that move down. Those gaps work brilliantly, and you should definitely employ the technique. Look at that. So we left that gap down and we came back up and we filled it. So here we still have unfilled gap up, and I'm pretty sure we will soon come back down and we will fill it. Then would be a question whether it was enough of a decline or it was just a part of the decline, but that would be another story. So because we had that kind of triangle looking pullback here, flat correction, there was no any reason just to go short here again, even though I could have bought back my puts cheaper than I sold them on Friday close. And here what you are looking for all the time when you are tracking an extended bull run, you are looking for an exhaustion gap making another high. And this is exactly what happened at the open of Tuesday. And I posted no change in the token count, gap up into the red target short box. Any new high or retest of the high made this morning will be a gift to bearers. Still expect the gap up at 276.60 to get filled. So it's very important that that type of technical analysis, Elliott wave, gives you confidence not to get discouraged when something not kind of very expected happens. So when you have that grinding tape here, the last thing you expect here is a powerful gap up, right? Because that part of the move looks like bulls are tired. We are ready to drop the ball, and you have to be quick to short because this is the very last opportunity. But in fact, it's not. Look at that white support line. I drew that line to show you that basically even at that point we did not have a really well pronounced corrective wave for down. This is what normally happens in 5-way moves. Look at that. We kind of had a flat wedge looking pullback and then another move up, but until here we still did not have a really well pronounced drop of wave 4, and then we got it. And after we got the drop, which actually killed bulls here because the majority of folks had their stops on longs here, then it made the final A, B and C. And this is another rule of thumb. I would strongly recommend you just to put down on paper that you always wait for that unexpected drop in wave 4 before you seriously start talking about the top in a major move up. So on a larger scale, for example, here if we track that whole formation as a 5-wave up, we had that move down. It's a major move down, and it looked it would never come back up again, but it still was wave 4. And this is why I started seriously counting that move up, because we had that well pronounced 4, and that was the time for the last advanced in ABC up. So coming back to the tape, we made that unexpected gap up on a Tuesday morning, and I actually loaded a bunch of puts a day. I picked 278 puts and 279 puts, and I picked puts to expire not the same week but the following week, just to buy some additional time in advance in case market would flatline here and would be burning time, killing all the bearers who loaded on puts. So this is another rule of thumb, and I would strongly recommend you always buy some extra time when you play puts or calls. And again, nothing happened here, and this is another story about another gap. Look, we opened up with a gap up on Tuesday morning, and so we saw a minor pullback just to fill the gap. That actually was a strong hint to me that we probably are not done with that advance, with that last rally. Another hint was that basically, you see how strong that line was. So we found resistance at that line several times here, there, and there. And this is a classic pattern. When we break out through such an important resistance, we gap up, so we may come down, retest it from above, and then we would go up again to test how strong bulls are and how much energy we are left with, and can it go higher from here, because in theory it could have gone up to here. But again, because we had those gaps, that added credence to the topping structure. So you always are looking for a confluence of fips, confluence of reversal levels, confluence of unfilled gaps. And when you have a confluence of them, a dense confluence of them, then you may use them as a place to attempt counter trend to counter trade the market. And for example, it's very important always to keep in mind a bigger perspective. Look, here we have that advance in wave parenthesis A and then pullback B. You always look for those bigger extensions. Here they are. And market rarely tops at 100 extension. Normally you will see 109.2, 114.4 or 123.6. Those are major topping extensions for the wave C of any degree. So that's why that 100 extension provided only a minor resistance here. It held for 1 day, not more than that. So let's move on. And again, those gaps, not only they work as reversal zones, and not only they work as resistance zones, but they are literally air pockets. It means that if price jumped one time during over that area, there is a chance that it will jump again in the future over that area. And this is exactly what happened here. The same air pocket, it just jumped over here. So we have a number of different items, landscape items, which together provided a good tell for us of what to expect in the tape. We still had that second target, 283.30 of 123.6 extension, untucked. So that's why I actually tweeted on Wednesday that though it has enough subways to be considered completed and has reached the target area, I can't stop thinking about potential of grinding higher to fill or at least tag the lower band of the gap down dated February 1st, 2018. So you should also understand, guys, that trading is a game of probabilities. You never know basically whether that gap up was a major top or not. It could have been both. So that's why I started my puts here and I held them, and I was expected to load more. Okay, so, and this is what happened on Thursday, July 26. So we finally got that crazy spike, which would fill up that last gap down dated February 2018. And I even put those red arrows just to give you an idea how important that area was. And again, this is a rule of thumb. If we are tracking some upside structure for a long time, and after that grinding stage, you may get that A, B, C up, where C would be a crazy one. For example, the classic Elliott wave theory believes that the most powerful rally can be seen only in wave 3 if we are talking about 5-wave up structure. But what I noticed that what is equally important is subwave C of wave 5. In many cases, it just gets crazy. It could have gone even higher. Sometimes I see that last subwave C is equal to 223.6% of the first small leg up A of 5. So it could have gone up right here and just to make a double top, but it didn't. And I loaded more puts the previous day, and Frankly, it was not what I intended to do, but I just had a lot of stinky bids in the system, and I just got filled for many of them. So at that point, I was pretty much loaded, and I did not feel happy here. You can tell that because all my puts were red. But I knew that it's such a beautiful topping structure, so I did not freak out much. I just turned off the screen and I went for a walk with my family. And this is exactly what you should do when basically you have a scenario, something is going on under your scenario, you have a position but the market keeps moving against you. It doesn't make sense just to stay at the screen and just look at that and burn yourself. You can't do anything. You have a scenario, you made your homework, you made your bet, and now you just need to give it some time to work out. Okay, and when it happened and when price jumped and then we saw only a minor pullback, I thought, okay, what is the worst scenario I can come up with here? Okay, and so I threw out another FIB structure for the whole advance in wave 1 to 3, and again the pullback of 4, and I saw the topping area. So that's why I posted on 26th of July that I do not have much space left for upside in this structure. Indeed, that was basically 28.78 was the max I could have envisioned, maybe 28.86. What bothers me is that wave 5 up hits all textbook extension but does not have a legitimate ABC structure. That's another story, and basically this is what we are supposed to see here, ABC, but it is what it is, and we will come back to that later on. So recap, we started to track the topping setup to short it on 17th of July 2018, and back then, I should tell you, I saw so many posts saying, oh, we have topped, I'm loading on puts, and this is again why I strongly recommend you to learn and practice harmonic Elliott wave theory, because it trains your eye for a structure, for 5-wave structure at least, and pretty soon you would realize until the structure is completed, you cannot and you should not say that the market has stopped, because even if we have that grinding stage when bulls look really tired, it doesn't matter. This is just another small subwave, but if you do not have 5 waves up on a microstructure with a well-pronounced wave 4 down and with the final advancement of ABC up, if you have not seen an exhaustion gap, if you have not seen a crazy C of 5, you cannot say that it's a high probability top. So back then on 17th of July we set two targets, the low target of 100% extension to 180.51 and the second target 123.6 extension to 283.30. And this is what I'm just telling you, that basically you should not pay attention to how it feels like or how it looks like. You should do your work. You should count waves in order to see whether the structure is completed. So basically this is my actual trades. I started to close my puts early, but for some of them I made 50-60% overnight, and because I had to add more than I expected and more than I was prepared, and I decided just to close part of my puts right away on the first drop. And just to give you a perspective, how it looked like, those are charts of those specific puts I traded. So there were a couple of good trades for that one, buying here, selling here. It's like buying about 70 cents and selling like 120. That was good enough for me. And there were a couple of trades for this put, and That put was not very lucky for me. You see, I started to load very early and I had to add 20 puts here and 25 puts there, so I sold part of them here and the remaining part there. Yes, I missed that huge rally, and frankly speaking, I had to buy here, and the structure was so beautiful, and I even posted the structure on my Twitter account. It was A down, B up, and I even picked the moment when market has just reversed down. You know, because I'm traveling, you know, I was kind of relaxed. It was Friday. I just didn't want to press, you know, my position. You can make all the money in the world. And there was another put. I traded very different puts for SPY and QQQ, and just I'm showing you just some part of them. I really made up good money, probably like equal to what I'm going to spend those coming 2 months while I'm on vacation. So I'm still pretty happy, even though I missed that exciting part of the rally. I picked a great profit here, there, and you could ask me basically how I managed to pick, you know, that spot very close to the bottom or here. And again, those stinky bit techniques, I would refer you to my previous video where I'm talking about stinky bits. And when you think that the structure is completed and you are ready to load on puts, in majority of cases, I do not buy puts from the offer price. I would enter my stinky bits into the system where I would offer the price which would be 20%, 25% lower than the current price, and I would just leave those bits and I would go for a walk. I would go for some excursion, I would go to a restaurant, I would go to a coffee house. I would not even looking at that, even because if I was ready to pay $1 for put, I should be equally ready to pay 80 cents per put. And if market keeps going up, it should not discourage me from buying puts, because I have made my decision. I'm just getting a free lunch, I'm getting 20% off. But if you keep watching the screen and you seeing that market keeps going up, the risk is that you would actually freak out and you would start tempering those stinky bits. You would think, okay, why I put only 20% discount? I may get 30% less. And this is when you miss your entry price. It happened to me many times before. I guess another put, 279 puts, August 3rd. And again, I picked some gain here, very little here. Yes, but the same problem. I just didn't want to trade on Friday. So what I want you to take away from this video, every time you think the market has stopped and it's time to rush loading on puts, you are most likely wrong. So in a bull market, surprises happen in favor of bulls. So market would normally grind higher than you initially expected, and you should never buy all the puts at once, and you should never buy the first tranche at least from the offer price. You should set your price lower for 20, 25%, even 50% than they currently offer you to buy. Never buy in one tranche. Be prepared to get filled on your stinky bits. Don't watch the market coming against you, because if you do, most likely you will freak out, you will cancel your bits. And in majority of cases, guys, that would be the highest top for the day, where you could have paid pennies for your puts, because everybody else would cancel their offers. And then we have that final spike up, and even if you have an ugly smelling bad bids for puts, those guys who got caught with those puts watching that spike up, they would freak out. And they would trigger their stops on puts, and your bid would be the only bid to fill. This is the idea behind the game. This is all about emotions. If you are not watching the screen, you cannot freak out, right? Because your bids are in the system. But another guy who was sitting there watching that and looking, oh my gosh, it's a major breakout, watching, you know, those numerous posts about perma bulls saying we are coming to the moon, he would most likely freak out and he would fill out your stinky bits, even though you still have unreasonable price. So the whole video, probably another idea I wanted to explain you, that to make money in the market, you do not have to press your trades. You may have a very limited number of investment theses for the week. For example, short indices, buy gold, or maybe short natural gas, or I don't know else. Maybe you might have 2 or 3 ideas. You don't need more. You don't need to stay glued to the screen watching somebody else posts with numerous ideas what to trade. If you have 2-3 good ideas, and if you have passions, and if you are ready to do some homework counting microwaves, then you put your bids in the system, you don't touch them. You can, what I normally do, for example, if I see puts trading at 122, I would put my first bid at 102, and then just in case I would put another bid for the same number of puts at 0.92, so 10% lower, because if the market goes against you in a bull run, it can grind higher than you expected. So now I'm prepared for that move, and I'm prepared to get benefit of that. I would get filled if those bulls get crazy and if they play that emotional fever. And I should not be there. I should not be watching that. So I made my bet, I'm going out. Or you can watch Netflix. This is what I was going to tell you today. I hope I will be able just to post more videos, but because I'm traveling, I don't even have Wi-Fi. My plan is just to record that video and go, you know, to probably Starbucks or McDonald's and try to upload that video. So hope, you know, I'll be lucky to do that. So again, please visit my website www.castawaytrader.com. Follow me on Twitter, and good luck with your trading.